So it was part A of the question 8 in this particular year, and the part A was worth 58 out of the 80 marks, which was 14.5% of the overall exam. So let's take a read of it. So Murphy Limited produces a single product. The company's profit and loss account for the year ended 31st of 12, 2013, during which 16,000 units were produced and sold, was as follows. So you've got the sales there, 16,000 units, which is 480,000. You've got materials, 120,000. You have direct labour, 110,000. You have factory overheads, 60,000. You have administration expenses, 105,000. So altogether there, your costs are 395,000 and the net profit, 85,000. So the materials, direct labour and a third of the factory overheads are variable costs. 65% of the administration expenses are fixed. So you are required to calculate, number 1, the company's break-even point and margin of safety. Number 2, roughly sketch a graph showing your break-even point. Number 3, the profit the company would make in 2014 if it reduced its selling price by 5%, increased advertising by 5,000 and thereby increased sales to 19,000 units, with all other cost levels and percentages remaining unchanged. Number 4, the number of units that must be sold at €26 per unit to provide a profit of 20% of the sales revenue received from these same units. And number 5, the profit the company would make in 2014 if a commission of 5% of sales is given to sales personnel and €1 extra per unit spent on new packaging, thereby increasing the sales to 17,000 units at €34 per unit. So you might remember from the last video where we came across the term sensitivity analysis. So it was the what if analysis. So what if there were changes to our selling price or our number of units that we produced or sold, or the increase in fixed costs or decrease in fixed costs or increase or decrease in variable costs. So you can see here number 3, 4 and 5 relate to that sensitivity analysis, that what if. So they're looking for you to find the solution to those changes. So what will the profit be there in number 3, how many units they have to sell in number 4, and then number 5, the profit, what will the profit be? Okay, so we'll get started. Now, before we start, it's important to check that we all know what our formulas were that we learned in the last video. So I would suggest that you take out a piece of paper and a pen, and without looking back, if you made notes on the formulas from the last video, don't look back at them and just see, can you write out the formulas again? Okay, for the contribution per unit, for the break-even in units, the break-even in sales revenue, for the margin of safety in euros, the contribution sales ratio, break-even point in sales revenue using the contribution sales ratio, and then finally sensitivity analysis. So I would pause the video now, okay, and spend 5 or 10 minutes just having a go at that, okay? Don't worry, don't leave anything blank, just attempt it. Think about what you're being asked and then write it down, whatever you think it might be. And sure, if you get it wrong, that's no problem, you can just go back and learn it. Just put extra effort into learning off that formula. Okay, so pause the video now. Okay, so hopefully you got on all right there, and you can check if you've got the right answers or not. So contribution per unit is the selling price per unit minus the variable cost per unit. The break even in units is our fixed costs divided by our contribution per unit. Our break even in sales revenue is the answer. It's your break even in units multiplied by the selling price per unit. The margin of safety is the sales minus the break even point in units. The margin of safety in euros is the margin of safety multiplied by the selling price per unit. Contribution sales ratio is our contribution, or our contribution per unit, over our sales or our selling price multiplied by 100. The break-even point in sales revenue using the contribution sales revenue, our contribution sales ratio, is fixed cost divided by contribution to sales ratio. And then finally, our sensitivity analysis is sales minus variable costs minus fixed costs is equal to profit. So if you don't know all of them, I'd stop the video now and spend 5 minutes going back over them, okay, before we go forward. Okay, so let's get started. So before we attempt any of these marginal costing questions, before we start going into part A, B, C, D, and E, as we've read out previously, what we're going to have to do is we have to make what's known as a marginal costing statement, okay? And we're going to do it based on the information that you see on the screen there now, okay? So you've got your sales, 16,000 units, and the total there is 480,000. You've got materials, 120,000 euro. You've got direct labour, 110,000 euro. You've got factory overhead, 60,000 euro. You've admin expenses, 105,000 euro. Altogether, you can see there you have costs of 395, which when you take that away from your sales, you've got a net profit of 85,000 there. So it's telling us that the materials, direct labour, and a third of the factory overheads are variable costs. So 65% or 65,000 of the administration expenses are fixed. Okay, so we're going to use this information in order to make our marginal costing statement. And what we do in our marginal costing statement is just separate out these 395 euro worth of costs into variable costs and fixed costs. And it's going to look like you can see here. So what we have here is we have our sales, 16,000 units and 480,000. Now here we also want to work out what is the amount per unit, because this will be useful for us when we're doing our question. Then we split up the variable costs. So we were told up here that the materials, direct labour and a third of the factory overheads are variable costs. So therefore 100% of the direct materials goes in there, 100% of the direct wages goes in there, and then factory overhead 60,000 multiplied by a third, so 20,000 there, and then factory overheads under the fixed costs, 2/3 are going to go there, so 40,000 there. Now 65,000 of the administration expenses are fixed. So if 65,000 of the 105,000 are fixed, therefore 40,000 must be variable. So it's split up there. Admin overhead under variable, 40,000, and under fixed, it's 65. Okay, so sales less your variable costs is equal to your contribution. So there should be 190 euro written there. So 190 euro should be written in there. Now, so what we want to do is find out what the variable cost per unit is. So 290,000 divided by 16,000 units is equal to 18.125 euro. Now, your 190,000 euro contribution, which is here, divided by the 16,000 units is equal to 11.875 euro. And that is your contribution per unit. Now, under fixed costs, we're going to add the fixed costs together, and that's 105,000, and that's your total fixed costs. When we take that away from the 190,000 contribution that is here, that is equal to 85,000 euro profit. So what you'll notice is that all we've done is we've split up the costs into variable and the fixed. But note that the sales and the profit, right, they've always remained the same. The amount of the costs are still the same. They're still 395, but all we've done, we've just split them up into the variable and fixed elements. So every single time we do a marginal costing statement, we have to, a marginal costing question, we have to do this marginal costing statement before we start part A of the question, before we even start answering it. Okay, so we're going to use this marginal costing statement the whole way through our question. Alright, so I'm going to keep it displayed on the screen at the top there. So every single part of the question that we go through, we should always be reverting back to this marginal costing statement that we have produced. Okay, so number one. So number one is always usually calculate the break-even point and the margin of safety. So the break-even point, hopefully you know what the formula is now. It's fixed costs divided by contribution per unit. So our fixed costs from our marginal costing statement of above are 105,000 euro. And then over our contribution per unit is 11.875. When we throw that into our calculator, we're going to get 8,842.11 something something something. But hopefully you'll know that we're going to need to round up because we cannot sell 8,842.11 something 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 of a unit. In order to break even, we're going to have to sell 8,843 units. Okay, so that's very important to know. So if you were asked what the break-even point was in euros, you would simply multiply the 8,843 units by the €30 per unit up here. Next, we'll have a look at the margin of safety. So the formula for margin of safety is sales minus break-even point in units. So our sales up here, 16,000 units. When we minus our break-even point that we've just worked out, and usually you'll get the mark for your own figure here if you didn't get this correct in the previous part. So 16,000 minus 8,843 is equal to 7,157 units is the margin of safety. So that's by how much your sales can fall before you will start making a loss. Okay, so part 2. This is roughly sketch a graph showing your break-even point. So in the last video we looked at how to draw a graph, and so this came up this year with 8 marks, all right, and your graph, they were looking for all of the following things to be labelled there. Okay, so in your vertical axis they want the revenue and costs. In your horizontal axis they want the output in units. They want the fixed costs, which is horizontal line going over like this. They want the total costs, which is your fixed costs and your variable costs added together. Your total revenue starts at 0 and works its way up like that. So the break-even point is where the total costs and the total revenue lines meet. The break-even in units is when we draw a line over to the vertical axis here for our revenue and costs, and that is 265,290. And you would get 265,290 if you multiplied your break-even in units, 8,843, by €30, which is the selling price per unit. Okay, and then they drew a line down to the horizontal axis, which is 8,843. So that's your graph, and note that it says roughly sketch a graph. All right, so you don't want to spend too long on this. All right, there would be no graph paper or anything like that. So roughly sketch a graph. There's not going to be that many marks going for it if they say roughly sketch a graph, and they don't want you to spend that much time on it either. Okay, so back to the question number 3. What would the profit be that the company would make in 2014 if it reduced its selling price by 5%, increased advertising by 5,000, and thereby increased sales to 19,000 units, with all other cost levels and percentages remaining unchanged? Okay, so this is sensitivity analysis. This is the what if scenarios. Okay, so we could change the cost price or the number of units that are sold, or the price of the fixed or the variable cost might increase or decrease. Okay, so in this question here, they're looking to know what's the profit going to be if the selling price is reduced, if the fixed costs, the advertising is going to increase by 5,000, and then if the sales in units increased as well, with all of the other costs staying the same. So the formula that we use for sensitivity analysis is always sales minus variable costs minus fixed costs is equal to profit. So how is the sales going to be affected? So we're going to sell 19,000 units, and the selling price has changed. It's been reduced by 5% from this €30 here. So €30 multiplied by 95% is €28.50. We then take away the variable costs. So our variable costs are our costs that change as output changes. And we can see here that the output has changed to 19,000 units. So we're multiplying the 19,000 units by the variable cost per unit, which is 18.125. Then we take away the fixed costs, and have there been changes to the fixed costs here? Hopefully you'll see that there has, Advertising has increased, so that's another 5,000 there. So the fixed cost will be 110,000. And the profit is our X. So the profit is what we want to find out. So our sales are going to be 541,500 minus my variable costs, 344,375. That's what we get when we multiply 19,000 units by 18.125. Then we will minus the fixed cost of 110,000, and that's going to be my profit. So my profit is 87,125 euro. So 87,125 euro. Now the next part, note 4. What is the number of units that must be sold at 26 euro per unit to provide a profit of 20% of the sales revenue received from these same units? So what you're looking for here is the number of units that must be sold. So the number of units that must be sold at 26 euro per unit to provide a profit of 20% of the sales revenue received from these same units. So I'd be reading this thing 2 or 3 times to yourself, okay, before you attempt it. But as you know, just write down your sensitivity analysis formula there. So your what if formula. So sales minus variable costs minus fixed costs is equal to profit. Now we'll go through each one bit by bit by bit. So what's happened to the sales? So the selling price is now 26 euro. The number of units is X. So the number of units we actually don't know. Okay, number of units we do not know. So minus the variable costs. So the variable costs are 18.125 euro. All right, but the number of units we don't have a clue. So we don't have a clue what the output is yet. So X amount of units multiplied by 18.125 variable cost per unit. There was no change mentioned to the fixed cost there. All right. And then the profit, so it says to provide a profit of 20% of the sales revenue received from these same units. So if we think about the selling price, so imagine we were selling something for 26 euro. To make a profit, 26 euro, the profit is going to be €5.20 per unit. So therefore the profit is going to be €5.20 multiplied by the number of units that must be sold. So all we do is we finish working that out. So we've got 26x minus 18.125x minus 105,000 euro is equal to 5.20x. So what we're going to do then is we're going to bring this figure with the x across over here, and we'll minus 5.20x, and then we're going to take this minus 105,000 euro, I'm going to bring it across over here, and that will make it positive 105,000 euro. So 2.675x is equal to 105,000 euro. So x then is equal to 39,253 units. And that's the answer to number 4. Number 5, the profit the company would make in 2014 if a commission of 5% of sales is given to sales personnel and €1 extra per unit spent on new packaging, thereby increasing the sales to 17,000 units at €34 per unit. Okay, so again, you've got your formula there, sales minus variable costs minus fixed costs equal to profit. So we'll read through it again. So what is the profit the company would make in 2014? So we're looking for the profit here. So profit is going to be X. If a commission of 5% of sales is given to sales personnel. So a commission means that for every unit that the sales personnel, the salespeople sell, they're going to get 5% of whatever the selling price is. Okay, so the profit the company would make in 2014 if a commission of 5% of sales is given to sales personnel and €1 extra per unit spent on new packaging, thereby increasing the sales to 17,000 units at €34 per unit. Okay, so the sales then. So the sales, the units is going to be 17,000 units and then €34 per unit. The variable costs, so we now have, we're selling 17,000 units and we're going to use this figure up here plus 5% of 34 because that is going to be the selling commission per unit. So minus 17,000 units by 18.125, which is our original variable cost per unit here, minus 17,000 units by €2.70. What is €2.70? That is what every salesperson would get per unit that they sell. They would get €2.70 commission. So have our fixed costs changed? So there's been no change to our fixed costs. And then our profit is the X. The profit is what we are looking for here. So our sales is going to be €578,000 minus €354,025 variable costs minus €105,000 is equal to our profit. So our profit is going to be €118,975. Now, so that's that question done. So part A, which was worth 58 out of the 80 marks. So again, it's 14.5% of the overall exam. So just looking at it briefly there again, the first thing that we have to do is our marginal costing statement, which is our sales less variable costs is equal to contribution less fixed costs is equal to net profit. And then we start at our number 1, number 2, number 3, number 4, number 5, using the ratios that you have learnt off. So it was part B this year. Barry Limited produced 10,000 units of product A during the year ended 31st of 12, 2013. 9,000 of these units were sold at €4 per unit. The production costs were as follows. So direct materials, 60 cent per unit, direct labour, 50 cent per unit, variable overhead, 40 cent per unit, and fixed overhead costs for the year, €4,000. You are required to, part 1, prepare profit and loss statements under marginal costing and absorption costing principles for Barry Limited. Part 2, outline the differences between marginal and absorption costing and indicate which methods should be used for financial accounting purposes and why. Okay, so this is it under marginal costing principles. Okay, so we have done this before, all right, when we were looking at our marginal costing, okay, when we were doing our break-even analysis and everything in all of those videos. So our marginal costing would be sales less variable costs is equal to contribution and then less our fixed costs. So we're separating our fixed and our variable costs out, okay? So you have here your sales, your 36,000 units, okay? And then you have your materials, 60,000 at 9,000 units, less production costs, so 10,000 units. So the sales were 9,000 units, but we produced 10,000, okay? So they produced 10, but they sold 9. So the sales are the 9,000, okay, multiplied by €4, but the production was the 10,000 multiplied by the direct materials, 60 cents, so 6,000 there, direct labour, 10,000 units by 50 cent, so 5,000 units there. And the variable overhead, 40 cents, so 4,000 units there. When we tot all of those up, 6, 5 and 4, we get €15,000. Now, the closing stock, all right, is going to be taken away from this figure here. So €15,000 it costs to make the 10,000 units. So what is 10% of that? All right, so the closing stock is 10% because 90% were sold. Okay, so the closing stock is 10% of the variable cost there, 15,000 units. So that is €1,500. So we take that 13,500 away from the sales and we get our contribution, which is 22,500. And from that then we take away our fixed overheads, all right, which is 4,000 units, giving us a profit of €18,500. So see here, direct materials, direct labour, variable overhead, fixed overhead costs for the year. So all you're doing is you're splitting them up, okay, and you're taking the closing stock as a percentage of the variable costs, okay. Now that's under marginal costing principles. Under absorption costing principles, it's going to look different. A lot of it's the same, but it's just that we are also adding the fixed overhead in here. Okay, so the fixed overhead is added to that In total then, the sum total cost of production then is €19,000, okay? And when we take away the closing stock is going to be 10% of the 19,000. All right, over here it was 10% of the 15,000 because fixed costs weren't included in that. All right, so the closing stock is valued more here because the fixed costs have been incorporated into it. So there you're going to get 17,100, okay, is your cost of sales, and then your profit then is 18,900. All right, so they are your profit and loss statements under marginal costing and absorption costing principles for Barry Limited. Okay, so part 2 of that is saying outline the differences between marginal and absorption costing and indicate which method should be used for financial accounting purposes and why. Okay, so let's have a look. So there's a difference in the profit figures because closing stock is valued differently. All right. Closing stock under marginal costing is valued lower than under absorption costing. When costing a product, marginal costing does not include fixed costs, whereas in absorption costing, the fixed costs are included. Therefore, a share of fixed costs is included in the value of stock under absorption costing and not included under marginal costing. Under absorption costing, closing stock is valued at 1/10 of the production cost of €19,000. Under marginal costing, closing stock is valued at 1/10 of the variable cost of €15,000. Closing stock under absorption costing, okay, is 1,900. Closing stock and marginal costing is 1,500, so the difference there is €400. The profit difference is 18,900 minus 18,500, which is €400. So absorption costing should be used as it agrees with standard accounting practice and concepts and matches costs with revenues. Okay, so just remember, marginal costing, they want to separate out the variable and fixed costs because they want to find the contribution. What is the contribution? So after the variable cost. So absorption costing is what we should use because it agrees with a standard accounting practice that says that every unit should have costs, variable costs and fixed costs absorbed into the unit. Okay, so that is 2014. So just the outline then about how we would lay that out. So just put in figures from the question you've just answered. So this is how they have laid it out. So under absorption costing, closing stock is valued at a percentage or a fraction of the production cost of whatever it is. Under marginal costing, closing stock is valued at a fraction of the variable cost of whatever the variable cost is. So closing stock under absorption costing is X, closing stock under marginal costing is X, difference is equal to whatever it is, and the profit difference is the profit of absorption minus the marginal is equal to whatever it is. So absorption costing should be used as it agrees with standard accounting practice and concepts and matches costs with revenues. Okay, outline the differences between marginal and absorption costing. Indicate which method should be used for financial accounting purposes and why. So there is a difference in the profit figures because closing stock is valued differently. Closing stock under marginal costing is valued lower than under absorption costing. When costing a product, marginal costing does not include fixed costs, whereas in absorption costing, the fixed costs are included. Therefore, a share of fixed cost is included in the value of stock under absorption costing and not included under marginal costing.